Imagine you're standing in front of a vibrant tapestry full of intricate patterns and hidden stories. To the untrained eye, it might seem overwhelming, but with a bit of guidance, it reveals a tale of highs and lows, trends and reversals. That's exactly what a stock chart is, a dynamic tapestry that tells the story of a company's performance over time. Understanding how to read a stock chart is not just about numbers and lines. It's about gaining insights into market behavior, potential opportunities, and the historical context of investments. Let's begin with the basics of stock charts. At their core, stock charts are visual representations of a stock's price movements over a specified period. They can be as simple or complex as you need them to be, depending on the type of chart you choose. The most commonly used types include line charts, bar charts, and candlestick charts. Line charts are the simplest form, connecting closing prices over a set period with a continuous line. They're ideal for gaining a quick snapshot of a stock's overall trend, but often lack the depth needed for more detailed analysis. Bar charts, on the other hand, provide a more comprehensive view. Each bar represents a specific time period, showing the opening and closing prices, as well as the highs and lows within that period. Candlestick charts, favored by many experts, offer the same information as bar charts, but in a more visually appealing format. The body of the candlestick shows the range between the opening and closing prices, with wicks indicating the highs and lows. Historically, candlestick charts have been a favorite among traders for their ability to convey complex information quickly. Once you've chosen your chart type, it's essential to understand what time frame you're examining. Short-term traders might focus on minute-by-minute or day-by-day charts, while long-term investors might look at weekly, monthly, or even yearly charts to identify broader trends. Data shows that the time frame can significantly influence your interpretation of a stock's performance, so aligning it with your investment strategy is crucial. Now, let's dive into the key components of a stock chart. One of the most important elements is the trend line. A trend line is a straight line that connects two or more price points and can extend into the future to indicate a stock's general direction. An upward trend line suggests a bullish market where prices are rising, while a downward trend line indicates a bearish market with declining prices. Many experts suggest paying close attention to these trends, as they often guide decision-making processes. Next, there's support and resistance levels. Support refers to a price level where a stock tends to stop falling and potentially bounce back up. Resistance, on the other hand, is where the stock usually stops rising and may turn downwards. These levels are critical as they help investors identify entry and exit points. Historically, breaking through resistance or support levels can signify a significant change in a stock's direction, warranting closer observation. Volume is another crucial aspect of stock charts. It represents the number of shares traded during a specific time period and is typically displayed as a bar graph at the bottom of the chart. Volume gives context to price movements. A significant price change accompanied by high volume gives more weight to the movement, suggesting strong investor interest or potential momentum. Conversely, a price movement on low volume might indicate a lack of conviction in the market. Moving averages are indicators that smooth out price data by creating a constantly updated average price. The most popular moving averages are the simple moving average, SMA, and the exponential moving average, EMA. Historically, these averages help in identifying trends by filtering out the noise of short-term fluctuations. Many experts suggest using moving averages as dynamic support and resistance levels, often acting as a guide for potential buy or sell signals. Finally, let's talk about technical indicators. These are statistical calculations based on the price, volume, or open interest of a security. Common examples include the Relative Strength Index, RSI, Moving Average Convergence Divergence, MACD, and Bollinger Bands. Each indicator offers different insights, such as whether a stock is overbought or oversold, trend strength, and potential volatility. While technical indicators can be powerful tools, it's essential to use them in conjunction with other analysis methods, as relying on them solely can lead to misleading conclusions. To bring it all together, learning to read stock charts is akin to learning a new language. It takes practice, patience, and a willingness to learn from each experience. Start by selecting a few stocks that interest you and practice drawing trend lines, identifying support and resistance levels, and observing how volume and moving averages correlate with price changes. Remember, the goal is not to predict future stock prices with certainty, but to build a framework that allows you to make informed decisions based on historical data and market patterns. As a practical step, consider creating a journal where you document your chart analysis. Note the trends, support and resistance levels, and any technical indicators you observe. Track the stock's performance over time and compare it to your initial analysis. This practice not only solidifies your understanding, but also helps you refine your skills in reading stock charts. If you found this guide helpful, take a moment to subscribe to WealthWire for more insights and strategies to help you navigate the world of finance. We're here to empower you with the knowledge you need to make confident financial decisions. Thank you for watching, and remember, every great investment decision begins with a well-read chart.